Hello, everyone. Welcome to the FHA overview. My name is Larry Hughes. I am your mortgage broker, and today we're going to be going over a FHA overview. What FHA means, what FHA can do for you when you're buying a home loan. So I got a couple notes here. Let's get to it. So FHA home loan. What does FHA stand for? First of all, FHA stands for Federal Housing Administration. And what FHA does. What FHA does is it administers an insurance policy for your home loan. I know that's outside of the norm of what you thought it was, but what FHA is an insurance policy against your home loan, because FHA does not actually insure or give you a home loan. It is a mortgage program that is insured by the Federal Housing Administration or the government, that allows you or allows the bank to recoup their any losses that would happen if you're qualified for this type of home loan. So FHA insures the actual home loan that lenders give you, and for that, banks and FHA have agreed to go to a minimum deposit or down payment of 3.5%. So we're going to write that on the board, because that's one of the common questions. What happens? What is the minimum down payment? Minimum DP is 3.5%. Right. So minimum down payment, we got that out the way, is 3.5%. And what is the minimum FICO score? Minimum FICO score for FHA, minimum FICO is 580. Now, there's a caveat. A minimum FICO score of 580 will get you an FHA loan, but will it get you a minimum down payment of 3.5%? No. At a 580 score, you're going to have to put down 10%. Your interest rate is going to be quite a bit higher, that type of stuff. But you can obtain for talking points. You can obtain an FHA loan with a 580 FICO score, but you won't be able to put down a 3.5%. It's going to be a 10% minimum. So, okay, so we talked about the down payment. We talked about the minimum FICO score. And is there mortgage insurance? Let's talk about the mortgage insurance and what is mortgage insurance. Since you're only putting down 3.5%, meaning that the bank is carrying a 96.5% loan to value, the FHA requires mortgage insurance. Right, so mortgage insurance is something that you have to pay for on behalf of the bank, because you're not insuring yourself, you're insuring the bank from loss, just as though Geico is insuring themselves from loss by insuring your vehicle, right? So you have to pay for the ability to put down that minimum down payment. You have to pay for that. So FHA mortgage insurance is in two factors. There's called an upfront mortgage insurance that you pay and is financeable. Most people, 99.9% of people, finance it. And then there's a monthly carryover cost every month that happens. So what does that look like? The financeable upfront mortgage insurance to start the process is 1.75% of the loan amount. Not too many people know that, and that's not a detail that most loan officers will give you, but that's what the actual is. So let's just say your loan amount after you put down 3.5% is $100,000. But add another 1.5% onto it, and then and that's financeable. With your monthly insurance, a monthly mortgage insurance cost is 0.85% monthly. Again, you don't need to know that when you're getting an FHA loan. You just know that there's a cost. There's a cost monthly for you have the privilege of getting a home loan with only 3.5% down, right? And getting the great financing terms with a high debt to income ratio and great interest rates. There's a privilege. There's a cost of that. There's a MI factor. And that again against the loan amount. So I mentioned something, debt to income ratio. Why is FHA so popular or so many homeowners want to go FHA? So despite the fact that you have a minimum FICO score of 580, um, interest rates are really low because it is insured. The banks are insured against loss, although you pay for the insurance. Um, the debt to income ratio is higher than conventional loans. So if you're comparing the two, conventional loans, most of them have a lot of them have a 45% debt to income DTI limit. Another subset of them will go to 49.99% debt to income. However, FHA uses the same underwriting engine but different rules, and it will go as high as 57%. My high is 54% that I've seen it go. So when we're talking about percentage-wise, what debt to income, that is real important because it allows you to utilize the amount of money you generate towards your, that is allowable for your monthly expenses. And what is debt to income ratio and how is it calculated? Debt to income ratio is simple. It's the bills you have, your current bills versus your salary. So let's say, let me erase this. Let's say you have a salary of $6,000 a month. But your bills, including your proposed mortgage that you're going to be getting, is going to be $3,300. Or let's round number sake, 3,000. Let me use a round number sake, 3,000. So how that calculation works is you divide 3,000 by 6,000, right? Or maybe that should be the other way around. So again, your bills divided by your income. And that will give you a 0.5 or 50% debt to income ratio. So now you throw your own number in there, right? And that includes everything that's reporting on your credit report, your anything reported in your credit report, anything from your student loan debt, your car payments, your credit cards, and they will throw in there if you have child support, alimony, stuff like that, which sometimes doesn't report in your credit report, but the requirement is to have that in there, and they do know. It's 2022, so they do know, or the bank will know that you have separate maintenance or child support. So in this instance, again, it is a 50% debt to income ratio. If you were going another program, conventional, that high of a debt to income ratio would not be allowed. Right? Anything over 50% is actually won't be allowed, and you have to pay off some debts or increase your salary fine or get a non-occupant co-signer, et cetera. All those type of things would have to happen for the FHA. So FHA, I mentioned earlier, the FHA has great rates. What are the rates today? I can't quote you on that. These are some of the comments I'm pulling up, some of the questions I normally get. I can't quote you on rates today, but as of this day, what it is, March 27th, we've been increasing for the past few months, and there's too many variables for me to give you an example now. But if you like some direct quote on what FHA rates are today, I'd invite you to give my office a call. Give my office a call and let's hop on the phone. Let's gather all your paperwork, your tax returns, W-2s, check stubs, run your credit, all that type of stuff, and figure out what is your scenario. And then I can give you a more and concrete answer of what rates will look like today and what it will look like for you buying property. So now the more important question is, right, what can you do? What can you buy with FHA, right? Another question that comes up is FHA a first-time home buyer program? No. FHA is not for first-time home buyers, not exclusively for first-time home buyers. You could have owned a house previously by an FHA. However, FHA is a program for owner occupancy only. I mean, you have to intend to live in the property. Now, is there FHA police out there that goes around, knocks on the door? I don't know. But the paperwork that you sign states that you intend to occupy the property. And if you don't intend to occupy the property, you're actually committing fraud. So I just want to give you that for a warning out there. Again, what can you buy with FHA? You can buy anything conventional. FHA or conventional, residential. Residential includes 1 to 4 units. So a single family home, duplex, triplex, quadplex, FHA includes all those. It even includes a mixed use property. What is mixed use? Mixed use is where you see some units on top and a storefront on the bottom. What FHA says is if the livable or rentable units on top is over 50% of the livable square footage of the actual entire property, then you can use the FHA program to buy mixed use property because you intend to live in one, right? You intend to live in one of the units upstairs, and the mixed use and the residential side of it is more than 50%. So a lot of times people use the term house hack. And FHA is one of the great ways to start when you're doing a house hack, right? FHA requires, again, that you intend to live in the property. But you can buy 4 units, up to 4 units, and rent out the other ones to help you pay for the mortgage. Now, we all know that 4 units cost a lot more than a single family home. Why? It's because the 4 units produce income. You live in 1 unit, the other 3 units produce income. So let's just say 1, 2, 3, and 4. Round number sake, these units can generate $2,000 each. Market rents. But you live in 1. So you live in 1. But now you collect, this is a real world scenario. Now you're collecting rents from the other 3 tenants. At how much? $2,000 each. That's $6,000. And what FHA says, it knows is that in the real world scenario, you're going to take these rents, you're going to put together any shortage, and then pay the mortgage. Use a real world scenario. But FHA does have a what's called a vacancy factor. And the great thing about FHA is that by allowing you to collect these rents and paying the mortgage, they're going to let you use some of this income on paper to help you qualify. Because again, we all know that 4 unit is significantly more of costs significantly more than a single family home. So what FHA says, on paper, we're going to allow you to take 75% of what you collect in rents and use it towards your income. So for each of these units, 75% of $2,000 in this example is $1,500. So we know $1,500 times 3 is $4,500 that we're going to take and add to whatever you make income-wise to help you qualify for the 4 units. Right now in Southern California, 4 unit properties are going over $1 million. Anything worth of 4 is going over $1 million. So you're going to need that $4,500 or more. Rents are if you're getting the 2 bedrooms here in Southern California, rents are more than $2,000. Rents are probably about $2,500. So you're going to need that. You're going to need that. You need those rents to help you qualify, unless you're a doctor or some other profession, you're making a lot of money. But you're going to typically need that income to help you qualify for the rent. So what happens is the appraiser goes out, he does a rental survey, and then FHA will give you, when he goes out to do the appraisal, he'll give you the market rents or the actual rents, whichever one is lower. So that is another thing that you have to jump through as far as FHA. Also, FHA has one thing that they do in speaking of these rents. They have what's called the self-sufficiency test. It says, FHA, again, a self-sufficiency test. If you don't know what it is, Google it. There's plenty of people are talking about it, but I'm going to go over it briefly. What FHA says is that these 3 rents that come in has to equal or be greater than the PITI of the purchase of the home loan. So $4,500 must be equal to or greater than your principal, interest, taxes, and insurance payment for the mortgage. If that is true, then the property passes its self-sufficiency test. And FHA allows you to purchase that home. So those things have to be true when you're buying FHA for units. Also, FHA requires some additional funds that you have to have in reserves for 3 and 4 units. Typically, it's 6 months. So what do I mean by that? Reserves. Let's just say your principal, interest, taxes, and insurance is equal to $4,500, right? So you pass the self-sufficiency test, but FHA says if when you buy the property, we want you to have 6 months of reserves, right? We want you to have 6 months of reserve just in case everybody stopped paying rent. You got to evict everybody or whatever happens because you bought the property. So $4,500 times 6 months. We're talking about they need to see $27,000 in cash or some type of liquid asset that they deem to be liquid that you can touch available to you somewhere so that you can pull it if need be. 6 months of payments or PITI. Remember your PITI, principal, interest, taxes, and insurance was $4,500. So 6 months is the $27,000. So again, if you don't know what that is, it's called the self-sufficiency test of FHA when buying 3 and 4 units. Those 2 things, you have to have the 6 months of PITI, and you have to do the self-sufficiency test. But just this FHA overview, all in all, it's a great program if you qualify, if you jump through the hoops, and if you have a great financial or mortgage broker who's going to work on your behalf. Because when you're doing this right here, it takes time to understand, right? It takes time to understand. It takes time to analyze each property, to do the self-sufficiency test, because it's not just like a single family house. Do you qualify? It's not just that. It's doing the self-sufficiency test, looking at the actual market rents if they're vacant or the actual rents, and doing the self-sufficiency test based on today's current interest rates. So that's FHA in overview. Again, if you would like to learn more about the FHA program or buy a home or get yourself on the path to that, I'd invite you to call my office, give me a call, and we can go over it. Let me see here. Do I have some banners here? If you see there about the bottom of the screen, my number, which is 323-228-2736. Feel free to reach out to the office. Reach out to me. Let's talk. Let's start the conversation. Let's get you pre-qualified to see what is your plan on buying some property. Maybe it's not FHA. Maybe it's conventional. Maybe you're a veteran. Maybe you're buying in a USDA country or territory. We can help. 323-228-2736. My name is Larry Hughes. I'm a licensed real estate and mortgage broker here in Southern California. My license number are going across the screen as we speak. Go ahead and reach out. Let's get connected to the office. Let's connect. Let's get you on the path to home ownership. Because as we know, rates are rising. Appreciation is happening. In Southern California, it's like 17% year over year. So the longer you wait, the more it's going to cost you. If you have any questions, please let me know. Thank you for listening.